Good morning, everyone.
Good morning.
Good morning.
Morning.
Good morning, everybody. My name is Kaisarali, and I'm the Director of Printing Professional Development, also Chair of the committee. So on behalf of the Society of Professional Accountants of Canada, I welcome all of you for this webinar. This webinar, in fact, is about a review and treatment of the government benefits and incentives that are related to the COVID-19. We're also going to talk about the voluntary disclosure and taxpayer relief. Before I continue, I would request all of you, if kindly keep your microphones on mute. About the question answer, I will be taking the questions in between the presentation. And in case anybody want to ask the question to the speaker directly, just raise the hand and I will unmute your microphone and you can ask the question. But in case in between you have any other question, kindly write your question into the question answer section down somewhere into your screen. You'll be able to see that. Today, our guest speaker is Ms. Kiran Chaudhary, who is Senior Tax Accountant at BPO. She's CPA and CGA, and she's a very experienced person. We have been enjoying her presentation during the last couple of years. In between, I also want to mention over here, ladies and gentlemen, that you may find there is some kind of voice disturbance in between, in case somebody's mic is open. So just accept my apology in advance. I'm going to mute all those mics where I find that this one has any problem into the broadcast here. So without any further delay, ladies and gentlemen, let me introduce you to Ms. Kiran Chaudhary. My pleasure to introduce our guest speaker.
Thank you. Thank you, Kaisar.
Yeah.
Good morning, everybody. Thank you for having me here today. Thank the RPA organization. I thoroughly enjoy coming here every year and giving you an update on what's going on in the tax community. And without further ado, I'll begin my presentation that I'm going to be talking today about the review of the COVID-19 government incentives and some details about the voluntary disclosure program that the CRA has. Okay, so to begin, this is a summary of some of the main COVID-19 government support incentives that were released back in March and throughout the year have been changing continuously on, almost a monthly basis. Right now, we're pretty much going back into lockdown if you live in anywhere in the GTA or Peel region. So a lot of these incentives that I'm speaking to you today might be slightly different in the coming weeks as the government slowly releases how they're going to provide support to the individuals and companies that are being negatively affected by COVID-19. So I'll start with the CERB. So the CERB is officially ended. There was a lot of issues with the hastiness of how the government released this emergency fund just to help support people who are, really relying on their paychecks and trying to make sure that they can, survive during the time that the government was still trying to figure out, how we can survive during the lockdown when everything was completely shut down. So they've now ended this program, but I'm sure you might have some clients or yourself or people around you might have qualified for CERB and received these payments. So I'm just going to go over what exactly the CERB was and who was eligible. So it's a taxable benefit of $500, up to $500 per week to a maximum of $2,000. And that was received for every 4-week period. So every 4 weeks, you had to go and apply and make sure you still qualify and are eligible to receive the CERB payment. Back when they first released this, pretty much everybody was eligible for this payment. And so there was quite a bit of fraud that went along with that whole hastiness of releasing this incentive for individuals who are eligible for it. The other qualifier was that you had to earn a minimum of $5,000 before taxes in the last 12 months or in 2019. From either employment income, self-employment income, or provincial benefit payments related to maternity or paternity leave. The other thing with the CERB payment was that there was no source deductions deducted at when these payments were made. So, you know, if anyone has more than the basic minimum amount of income in the year, they're probably going to have to pay some taxes. And so that's kind of something that people need to be aware of. They need to make sure that they put some money aside to pay for that income tax come this April. Also, because there was not a lot of due diligence that the government had issued when they decided to give these payments out, and you know, they pretty much gave this payment out to anyone who applied. You know, CRA has now decided that they're going to, you know, a lot of people might have received these payments that were not actually eligible to receive this payment, and the CRA is giving these people the opportunity to repay any CERB amount that they were not eligible to receive by December 31, 2020, without any sort of penalty or you know, charges, I guess, for maybe possibly fraud in this situation. So after the CERB ended, I guess it was a very administratively difficult for the CRA to actually handle this. They decided to just move the entire program into the EI program. So now, as of September 27th, these are the rules that allow you to be eligible for the EI. I won't go through every single detail, but you must have been employed for at least 120 insurable hours in the last 52 weeks. You stop working through no fault of your own, same thing as the regular EI criteria. And this benefit is also the similar amount, maximum taxable benefit at $500 per week and $300 per week for, I guess, paternal benefits. So then there's also another benefit for individuals called the Canada Recovery Benefit. And this is for people who are not actually eligible for EI for because they're self-employed or they work in the gig economy, such as Uber or DoorDash. So this amount is also a taxable benefit in the amount of $500 per week for up to 26 weeks. And each payment covers a 2-week period. And so individuals will have to reapply every single 2 weeks. I guess they're kind of trying to align that with the 14-day quarantine period. So, you know, if you were kind of affected by COVID and you can't work, this is kind of a way for them to help you. And then the other thing that you need to look out for is that if any individual has annual income of over $38,000 in the calendar year, then they are going to be required to repay some of this CRB that they've received, about 50 cents for each dollar. This benefit is effective from September 27, 2020 until next year, 2021. Compared to the CERB, the CRA will withhold 10% at source for all of these payments that are made. And again, these amounts are taxable. So another one that they have provided is this Canada Recovery Sickness Benefit. This again, another $500 per week for a maximum of 2 weeks for workers who are unable to work for at least 50% of the week because they got COVID, are self-isolated for reasons related to COVID. They either have underlying conditions or undergoing treatment or have contracted other sickness that would make them more susceptible to COVID. And this is for people who cannot claim the CRSB. Workers cannot claim the CRSB if they received other paid sick leave from their employer for that same benefit period. So if you're employed, if you don't have enough sick days provided by your employer, this is something that you would apply for, and this is the support you would receive. So now I'm going to talk about the corporations, the support that was provided to businesses. So the first one is the Canada Emergency Business Account. This is an interest-free loan. This program is a $25 billion program the government has decided to put into this, and they're willing to provide interest-free loans up to $40,000 to small businesses and not-for-profits to help them cover their operating costs during the period that their revenues were temporarily reduced. So this is not money that businesses or not-for-profits can use to buy any sort of capital assets. It has to be used for specifically operating costs. And to apply for this program, the government has partnered with the financial institutions. So essentially, you just go up into your bank. If you are qualified for this, you would go into your bank, and they would process and handle the entire funding component of this and the approval process as well. So effective April 6th, organizations need to demonstrate that they paid in order to qualify, as of April 6th. The emergency business account has been changing, almost quarterly. I guess the CRA is reviewing this. So as of April 6th, you're able to, if you are able to demonstrate that your organization paid between $20,000 to $1.5 million in payroll in 2019, you can apply for this interest-free loan. And the other good part about this loan is not only that it's interest-free, it's also if you repay this loan on or before December 31, 2022, the CRA will forgive up to 25% or a maximum of $10,000 of this loan. And there's some tax consequences of that as well that I'll discuss later. And effective May 19, applicants with payroll lower than $20,000 are now eligible to also receive this interest-free loan, but they would need to have an operating business account at a financial institution. They would have to have a CRA business number and filed a 2018 and 2019 tax return. And they have to have eligible non-deferrable expenses between $40,000 and $1.5 million. And I'll explain to you what exactly they mean by eligible non-deferrable expenses in my next slide. So some examples of this are of non-deferrable expenses that they would include. Would be, again, wages and employment expenses to third parties. So paying your, non-arm's length people like your spouse or children, that would not be considered as part of this, as eligible deferred expenses. Some other expenses are like rent or lease payments for real estate, rent regular rent, lease payments for capital equipment used for business purposes, and other things like telephone, utilities, internet would also qualify. There's quite a long list of expenses that the CRA has decided are included in eligible non-deferrable expenses. So on the CRA website, if you go look into this, so if your clients have other expenses that maybe I didn't list here, they still might be able to qualify, even if their payroll is not meeting that minimum $20,000 threshold. And of course, as always, these expenses will be subject to verification and audit by the CRA. So just always have to make sure you have all your supporting information in case the CRA ever asks you questions. So effective October 9th, there were a couple more changes. The government announced an expansion to this program, and they have decided to include an additional $20,000. Up to $10,000 will also be forgivable if the loan is repaid by December 31, 2022. So if you are totally qualified for the maximum loan, you can get up to $60,000 interest-free, and of which $20,000 would be forgivable if you repay this loan. So you'd have to repay $40,000 of this loan in order to be eligible for that forgiveness amount. There's not too many details right now. The government is still trying to figure out some more details about the policy and the legislation around this and how they're going to implement it. But so just stay tuned for that. So now the taxation of this. So for tax purposes, in the forgivable portion of the loan must be included in income in the year that the loan is received. So that might, cause an issue because the loan might not actually be forgivable until 2022, and it's dependent on if you actually repay that loan. So if you don't, so you might not know at the end of 2020 if you're going to. So I guess in 2021, depending on when your tax year is, if you're actually going to be able to repay that loan. But you're required to include that income, that amount of the forgivable amount in your income in the year that you are expected to. Basically, the CRA is expecting that you're going to you're going to get the loan forgiveness. So that's part of the caveat of getting this loan. So they require that you include it in your income in, I guess, if you received it in 2020, so in your 2020 tax year, you'd have to include this in your income. If however, like later down, and let's say in 2022, you've now just realized you're not going to be able to repay that portion of the loan, and so therefore you will not be qualified for the loan forgiveness. There is actually the taxpayer is entitled to a deduction in income at the end of for the 2020 tax year. They can deduct under subsection 21HH the portion of the loan that was actually included in income, the forgivable portion that was actually included in income back in 2020. So there's kind of a timing difference here. The other thing the CRA has provided is an election under subsection 12 sub 2.2, and this is a kind of a tax deferral opportunity that the CRA is given to business owners who have received the loan, but their expenses, they haven't used the full amount of that loan towards their operating expenses at the end of the year, at the end of 2020. So let's say they got the $50,000, let's say they got $40,000 and they only used half of it in 2020. So you don't have to include the full $10,000 forgiven amount in your income. You could just prorate that. So half of that would be included in your income. And then that way, the next year when you use the rest of the 20,000, you can include that forgiven amount in the following year. But you have to file an election. An election you have to file in order to use this method of accounting for this loan forgiveness income inclusion amount. So the next one is the Canada's Emergency Rent Subsidy, the CERS. So the CERS, it replaced the original CERCA, which was the Canada Emergency Rent Commercial, sorry. I don't remember what it was. I don't remember the full name, sorry, but you can Google it. Anyways, it's been replaced. And the issue was that that program was actually allowing for the landlords, they had to apply and they were kind of getting the benefit, but they were only qualified to receive this subsidy if they reduced their rent to their tenants. And so that was kind of difficult for a lot of landlords. They didn't want to reduce the rent that they were charging, and they were eligible to get up to 75% of the amount. And yeah, so that was something that the CRA didn't really, the landlords weren't really cooperative with the small businesses. So it wasn't very a successful program because it required the landlord and the small business owner to kind of work together, and it caused a lot of issues between the two parties. And so the CERCA was for small businesses, provides forgivable loans to eligible commercial property owners rather than direct rent relief to impacted small businesses and tenants or subtenants. And the funds are used by property owners. Those funds were used by property owners to cover up to 50% of the gross rent for up to 6 monthly rent payments payable by the eligible small business tenants that were experiencing financial difficulty due to COVID-19. Under the CERCA, the property owners were required to use the funds and reimburse the impacted tenants for any rent that they paid above the 25% that they were required to pay for the property owners to be eligible to get this subsidy. So in contrast to the CERCA, which required the commercial property owners to apply on behalf of their small business tenants, the CERS will provide support directly to the qualifying tenants and property owners. And this program is not restricted to small businesses. Any business can apply for the CERS program. And the CERS program will be available retroactively to September 27, 2020, and it's going to be available until June 2021. Oh, sorry. So the other requirements of this in order to be eligible to apply for the CERS will be that you have to have an experience in a drop in revenue. That's one of the eligibility requirements. The CERS mirrors the exact same qualifying period as the CEWS, so the wage subsidy program. CRA decided to make these in sync, so just administratively it's easier for them to process. And so the CERS amount, it's comprised of a base amount and a top-up amount. So the base rent subsidy will cover on a sliding scale up to a maximum of 65% of the qualifying rent expenses. 65% is the maximum amount that any business would be able to receive, and if the maximum amount of 65% is essentially demonstrated when a business has a revenue decline of at least 70% or more in their business. And so that's how, so there's a base rent subsidy, and now the government has also included something called their lockdown support. And that's a top-up amount of an additional 25% of qualifying expenses for any businesses that are subject to lockdown restrictions. So this would be very relevant for any businesses right now in Toronto or Peel that are now gone into lockdown. They would now be eligible to apply for not only just the base rent subsidy if they were eligible for that, but now also they can apply for the lockdown support as well. And so through this program, businesses can essentially get up to 90% of their expenses paid for through the subsidy. Okay, so here is just a little chart. Got a little cut off there, but all the information's there. So here's just a chart of like how to calculate the base subsidy and the different revenue thresholds. So yes, if you have 70% and over, you get 65% of the subsidy of your base rent of the subsidy. If you have 50 to 69, it's a little bit more of a complicated calculation over here. And then similarly, if you have 1 to 49% revenue drop. So regardless of, based on this, regardless of how much you have, you might be eligible for even a little bit. Even if your revenue has declined 1%, you can apply for this base subsidy. I mean, it might not be a significant amount that you'll get, but if you pay a lot of money in rent, it might be worth it for you. So now, more information about this. So the qualifying rent expenses that the CRA is going to look at to determine how much you are eligible for, what your subsidy rate is, what amount is based on your qualifying rent expense. And so for commercial tenants, this generally will include obviously the rent that they're paying, and the rent based on however way your rent is calculated, any property taxes or that you have to pay, or any common area, utility maintenance expenses that you have to pay. And if you are and then qualifying rent expense for property owners would include mortgage interest, insurance on the real property, and property taxes. These expenses incurred by property owners who use the real property, whether directly or indirectly to earn rental income, are not eligible for the CERS. So if you are just a property owner and you just earn passive rental income, you're not going to be eligible for the CERS subsidy. Yeah, as I said, the CERS will be available starting September 27. And for the base subsidy, expenses for each qualifying period will be capped at $75,000 per location. So if you're a franchise, or like if you're a business that owns a franchise in multiple locations, then each location would be eligible for the rent subsidy on an individual basis. And that would be capped at, there's an overall cap. So each location qualifies for $75,000. And on an overall basis, the maximum is going to be $300,000. So let's say you own 6 coffee shops throughout Ontario, and in total you're paying $400,000 in rent. The maximum that you'll ever be able to get from the subsidy is $300,000, even though you're paying more rent, and let's say your revenue declined that over 70%, and you were also eligible for the lockdown support, so you're looking at getting 90%, but you're capped at 300,000 irrespective. And this would also be shared among affiliated entities. So if you have a group of related companies, you also have to share that $300,000 maximum limit. Not each company gets their own $300,000 limit. It's based on the affiliated group. So now, in order to determine how to calculate the percentage revenue decline, this essentially mirrors, as I said, the CEWS, which I'm going to talk about in length. So it's pretty much the exact same. There's two options that every business owner paying rent has to choose from, which is either the general approach or the alternative approach. And the general approach is determined by using the change in monthly revenues year over year for the applicable calendar month. And that means basically if you're applying for this rent subsidy for the month of October 2020, you're going to compare what your revenue was in October 2019. And that's how you'll figure out if you have what percentage of revenue, what your percentage of revenue decline was. And that's how you're going to determine what your base subsidy is. And under the alternative approach, you would compare the same, you would compare let's say for the same example for October, you'd compare your October 2020 revenue with the average of the January and the February 2020 revenue. And you can calculate under each approach, but once you pick an approach, you have to stick to the same approach. You cannot change the approach because 1 month you have a higher subsidy, a higher revenue decline. You have to be consistent with the way that you do this. And again, the qualifying periods, they're not really calendar periods. We're going to take a look later at the chart of what the periods are. They're very odd dates. So, and they're aligned with the CEWS. So it's pretty much the same way. Again, the government intention is to link these programs to just simplify the administration of it. And I already discussed the base subsidy caps as well previously. So now I want to just go a little bit about the lockdown support. This is another new add-on to this, and this is available to organizations with locations that are temporarily forced to close or temporarily have their business significantly restricted due to public health orders that were issued by the laws of Canada or the province or territory. So, for example, even though we're in lockdown now, effective Monday, a lot of the restaurants were restricted to not being able to have dine-in, or they were only able to have a capped amount of people, maybe like 10, but their restaurant actually seats 100. So this is another support, the additional amount. They would qualify to also receive this lockdown support for the rent subsidy. And then so for organizations to qualify for the lockdown support, the following conditions must apply. They have to qualify for the emergency rent subsidy. So they have to qualify for that base amount. If you don't qualify for that, they can't qualify for the lockdown support. And the public health has to order the organization to completely shut down the location or cease some of or all of its activities at the location. And it is reasonable to conclude that the ceased activities in an appropriate pre-pandemic prior period reference period were responsible for at least approximately 25% of the revenue of that location. So if you have a location, let's say you have a restaurant that has both dine-in and takeout, but at least 25% of your revenue was not based on the dine-in. If you don't meet that threshold, then you cannot qualify. You have to have at least minimum of 25% of your revenue coming in a pre-pandemic period, coming specifically from whatever the activity is that the government has ceased. So like the restaurant. So your restaurant, if 25% of your revenue is not from dine-in, then you cannot qualify for the lockdown support because your business is not dependent on the dine-in to be profitable. Also, the lockdown support would be prorated based on the number of days in the period during which the relevant location was shut down. So, a lot of right now only Toronto and Peel are in lockdown. The rest of the province is not. So let's say down the line, some of the other provinces join. You have let's say the middle of the month, it would be prorated. You don't get the support. You don't get the support for the full month. You have to count the number of days that you were shut down in the period in order to calculate what the subsidy amount is. And unlike the base rent subsidy, the lockdown support is not subject to a sliding scale based on the percentage of revenue. It is fixed at 25% as long as you qualify for the emergency rent subsidy and you were forced to shut down, you automatically will qualify to get the 25%, and that's a fixed amount. It doesn't depend on how much your revenue decline is. And for this, eligible expenses are capped at $75,000 per location, but there's no overall cap for the lockdown support as there was for the base, which was $300,000. So the lockdown support is pretty nice incentive. The government is really, really trying to help those businesses. So here's an example of how you would calculate this. In the simple example, Sonia is an owner of a gym that was fully locked down on September 20th under provincial order. In September, her revenues were down by 50% because of social distancing measures, and her revenues in October will fall to zero. Her rent expense for the period are $10,000. Sonia will be eligible for 25% lockdown support or $2,500. Because her revenue has fallen. And in addition, she'll receive the base rent subsidy of 65% for a combined total of $9,000. So another more complicated example, there's a Restaurant Inc. It's a chain of 10 restaurant locations. In September, their revenues were down 70%. And in October, revenues were down over 80%. When the dining rooms of 6 of their 10 locations were shut down under a public health order that was effective October 10th. Restaurant Inc. incurred rent costs of $400,000 in respect of the period. So in this example, October. And $120,000 of which related to the 6 locations that were closed by the public health order. Under the rent subsidy, Restaurant Inc. will be eligible for a base subsidy rate of 65% because they had over 70% decrease in revenue from one period over the prior period. And plus the new lockdown support of 25%, only with respect to those 6 locations that were closed due to the public health order. And in this case, only 15 days out of the 28 days qualify for the new lockdown support. So that's a calculation that has to get done. Restaurant Inc. will be able to benefit from the base subsidy and the lockdown supports. So the base subsidy would apply on $300,000 in eligible expenses. So that's the monthly cap. So even though 65% of $400,000 is more than $300,000, the cap is $300,000. And they would get a benefit of $195,000 in total. The lockdown support is only capped per location, meaning it would apply on $120,000 of eligible expenses. So the 6 locations, I guess they're in this calculation, we're assuming that it's $20,000 for each location. And there's a proration calculation based on the qualifying business period. So the support would be $16,071, which is based on the $120,000, 25% of that at the prorated 15 over the 28 days of that specific period. Again, this period is based on the same period as the CEWS, so you have to look at that specific period. You can't assume it's based on like a October 1st to October 31st month period. That's not what the periods are in this situation. And so in this case, he would get $200,000 for the month of October to help support the rent expense. So now I'm going to talk about the wage subsidy. So this subsidy is to help businesses of all sizes that were faced with a significant decline in revenue to either keep their workforce on payroll or to rehire them. This was, in doing so, this would keep workers off EI and the CERB benefit as well. The CRA really wanted the employers to kind of incentivize them to not lay off their workforce and have half the population kind of dependent on the EI and the CERB payments. The CEWS is 75% in certain periods. Periods 1 to 4, there was a base 75% wage subsidy that was being offered to businesses, and it was calculated on a per employee per week basis based on a maximum weekly wage of $1,129. So if you had $1,129 weekly wage of your employee, the maximum that you could receive for the first 4 qualifying periods of the program was $847 per employee, and then $960 per week for the next 2 periods, so period 5 and 6, and then again they went back down to $847 for the following periods, and $734 for the qualifying periods that ended October, November, and December. The subsidy is determined by the CEWS rate, which is determined by the rate of the revenue drop in the month when you compare it to the same month in 2019, or the average revenue arising in January and February of 2020. So same calculation as for the rent subsidy. So, sorry. Okay. So for qualifying revenues in March, there must have been a comparative decline in revenue of at least 15% in order to be eligible for the CEWS. This was increased to 30% for each comparative revenue declines for April, May, and June of 2020. For these 4 periods, the rate was fixed at 75%. And then for the remainder of the qualifying periods from July through December, there's actually no minimum revenue decline required to qualify for the CEWS. But the amount of the CEWS is dependent on the comparative revenue decline in those qualifying periods. So there's a complicated calculation. I'm going to go through that with you later on an Excel document that I've created. So in order to be eligible for the CEWS program, all employers must meet the 3 criteria. The first criteria is that they must have had a CRA payroll account on March 15, 2020. They must be one of the type of employers, individuals, corporations that are not exempt from income tax, and registered charities. So non-for-profits are actually not eligible to receive this, the CEWS. And the third requirement is that there has to have been a drop in revenue. And so eligible revenue generally includes revenue earned in Canada from selling goods, rendering services, and use of your resources. So any income you're earning from there. With respect to charities, if you're a charity, the eligible revenue would include any gifts, donations that you received or would have received. And in order to calculate this, you would generally use your normal accounting method when calculating your eligible revenue. For the CEWS, the CRA has allowed you to use either the accrual method or the cash method. So you can elect to use either, but you have to use the same method for all of your claims. So, but however, for periods 1, there was a change in that. So in period 1 to 4, if you decided you wanted to use the cash method, then you could only use a cash method for periods 1 to 4. But then come period 5, you had the opportunity to change how you wanted to use, what method you wanted to use. And then when you're applying for it, you need to make sure you select the election box that you're using the cash method, because CRA assumes that you're using the accrual method, as that's the generally acceptable way to report this income. So the criteria for the CEWS, which main criteria is the drop in revenue. So from periods 1 to 4, the minimum drop amounts qualify for a fixed subsidy rate of 75%. So there's the minimums that, as I noted, they were 15% in March and then 30% for all the other periods. And as long as you have that minimum drop, you qualify for 75% subsidy rate. The drop in the revenue is based on comparing the baseline revenue with the current period revenue. So using either the general or the alternative approach. And again, in this case, you could not switch between the approach that you decided to use. So once you picked one, you couldn't switch, but come the claim period 5, you were eligible to decide if you wanted to use the general approach or the alternative approach. So for periods 5 and later, there's no minimum revenue drop required to qualify for the subsidy. The rate your revenue has dropped is only used to calculate how much subsidy you receive for those periods. And for the overall CEWS, you would receive a base rate, and then you may even qualify for a top-up rate. And the top-up rate applies to eligible employers whose revenue had dropped more than 50% in a particular period of 3 months. So they would compare the 3-month average, the preceding 3-month average rent revenue decline with the previous year, depending on what approach you're using, with either the previous 3 months and of the prior year, and that would be depending on if that revenue dropped more than 50%, you would also get the top-up rate. So for periods 5 and subsequent claims, businesses may want to wait to make their claim if they can afford to wait for this subsidy until they have a better idea of what their revenue trends are in the following month, if at the current time it's not known. Because once you, again, in period 5 and later, once you decide what approach you want to use to get the subsidy, you cannot change it. So if you don't need the money right away in, let's say, period 5, you can wait to apply for this later in other periods, once you have a sense of what approach is the most beneficial for your clients. So there's no timeline or deadline really to apply for this. So you are able to wait it out and see how your revenues are projecting throughout this periods 5 and later, and then apply for the subsidy retroactively. So another thing about the CEWS program is this thing called the deeming rule. So for periods, this is only applied for any CEWS that were eligible for the period 1, 2, and 3. So the deeming rules essentially, if you determine that you qualified for the subsidy in one claim period, you automatically qualify for the following period. Even if you actually don't qualify for that period, CRA has deemed that you qualify for the following period. So you do not have to submit a new claim, and you don't have to redo this calculation to make sure that you are eligible. So for example, if your revenue dropped 30% for period 2, you don't need to recalculate your drop for period 3, but you would have to recalculate it for period 4 in order to determine if you qualify for the subsidy. The deeming rules do not apply for periods 5 or later, so you actually have to do the calculation, and that's why as I said previously, you might want to hold off on making the application using the specific approach, because there's no deeming rule. So if you don't qualify based on the specific approach you used but you apply under the different approach, you will not be able to apply for the CEWS subsidy. Okay, so here is just a summary outlining the qualifying periods and the dates. So as you can see, they're very odd dates, kind of like in the middle of the month, beginning of the month. So it doesn't always line up. And then I have noted here the required rate of reduction in revenue in order to be eligible for it, the 75%. So in these 4 periods, it was a baseline 75%. As long as you meet those required reduction in revenue rates, you get 75%. And then, so the current reference period is, let's say for March 2020, if you're applying your prior reference period in order to determine what your baseline revenue drop is, you would compare what your revenue was in the 2019 year. This would be under the general method, where you pretty much just compare what your revenue was for the month of March and then compare that to the prior year of March. Or you could use the alternative method, which is basically just the average of your January and your February 2020 revenues. So for periods 1 to 4, 2 benchmarks are being provided to measure the revenue decline. So I mentioned that already, the general and the alternative method. And then I mentioned the deeming rule. Okay. So now this one is for the periods 5 or later. This is just to calculate the baseline revenue drop. Remember, there's the baseline and then there's also a top up. So for periods 5 to 10, so right now, the CRA only has provided details up to December 19, like the 10 periods, pretty much up to December 19. They have not provided any guidance on how they're going to administer or possibly change these rules, expand these rules after December 19. So we're still waiting on the legislation for that. But the CEWS program has been extended until June 2021, but the guidance has only been provided up until December 19. So starting in period 5, the applicable and the subsequent periods, the wage subsidy rate is no longer fixed at 75%. And it's directly determined by the percentage drop in revenue between the reference periods. Note that the general rate of CEWS will decline after period 4, but there's also something called a safe harbor rate of 75% for companies with at least 30% revenue declines, and this is applicable for periods 5 and 6. So let's say, even though, let's say based on the calculation, you're not eligible, you're not hitting that that threshold to get the 75%. The CRA is still providing you with the ability to get the 75% only for the periods 5 and 6, as long as you have at least 30% decline in revenue. Also, starting period 5, there are 2 parts to the revenue test. So I said, so the revenue test for the base CEWS is one, comparing the revenue in the current or prior month to the same month in 2019, or alternatively comparing the revenue in the current or prior month to the average of the January and February revenue. So you would use the rate that's greater. So for example, let's say period 5, which is July. The general approach allows you to compare the decline in revenue between the month of June 2019 and June 2020, or the month of July 2019 to the month of July 2020. So you have a lot more options of figuring out if you can still qualify for this wage subsidy. And you have to be careful, because once you decide to choose one approach, again, either the general or the alternative, you can only use that for the remainder of the program. So then for part 2 of the revenue test is for the top-up component. So here's the details for the top-up component. And the top-up rate is added to determine the overall subsidy rate for active employees, and it's calculated by subtracting 50% from your top-up revenue drop and multiplying that result by 1.25. So the same chart that I had in the previous couple of slides for the rent subsidy, it's the exact same calculation to calculate the top-up rate. So the top-up revenue drop, if it's 70% or higher, the top-up rate is going to be 25%. If the revenue drop is 50.01 to 69.99, CRA is very particular. If there's no rounding up or down when it comes to this. You're either 70% or higher, and if you're 69.99, you do not qualify for 25%. You now qualify at 1.25 times the top-up revenue drop less 50%. And if you have a revenue drop of 50% or lower, you do not qualify for the top-up at all. And here in this chart is I've just laid out how to calculate the difference between the general and the alternative approach. So in the general approach, it's comparing the average of the prior 3 months of the qualifying period. So let's say for qualifying period number 5, which goes from July 5th to August 1st, you would take the average of your April, May, and June 2020 revenue, and you'd compare it with the average of the April, May, and June, and see what that revenue drop rate is between those 2 periods. And if you're using the alternate method, you would essentially compare the same 3-month average, but you would compare it with the average between January and February 2020. So now the taxation of this claim. This is considered taxable and included in income when the subsidy is received. Now, the Act, it contains a specific provision that the subsidy is considered to be received on the last day of the qualifying period that it relates. So therefore, any claims that are made but not yet received, or a CEWS claim will be made, the anticipated amount of the claim must be included in taxable income. So there's kind of a timing issue here that happens where, for example, let's say the June claim period ended on July 4th. For income tax purposes, it will be recognized as income in July 2020 and accrued for accounting purposes as income in June. So this is, a timing difference, particularly for like a June year end. And this would happen for all year ends. So this is something you need to take into account and make sure that you're not including something that shouldn't be included in income and including the subsidy when it is actually supposed to be received. So this could be, so the timing issue that I mentioned could be particularly problematic where a claim has been delayed. In order to minimize uncertainty about elections, that can be made with a claim. So this also means that if a tax return that was filed prior to making a claim, that might need to actually be amended for the amount of any claim made after filing that are deemed to be accrued prior to the tax year end. The qualifying claim periods are 4 weeks long and do not coincide with the calendar months. For example, so this is the example that I gave you. Okay, so CRA, of course, is auditing these CEWS claim very heavily. They've actually started sending out audit letters to as of September. So, just to keep a lookout for this if you've applied for this claim for your clients. And the government has actually implemented really strong penalties for businesses that are found to not have met the eligibility requirements after receiving the subsidy. So any businesses that are not compliant with the rules, the consequences of that can include repayment of the amount received, fines up to 25% of the amount received, and an additional 200% in the case of a fraudulent claim, and the penalties for up to 5 years in prison for individuals who submitted the fraudulent claim. So now the individuals who have a principal responsibility for the financial activities must attest to that the application is complete and accurate. So if you are making this claim for your client, you have to attest that this is accurate. And if for any reason the CRA thinks that there's some sort of it was incorrect or there was fraud, I mean, you personally would be subject to the penalties for this, not your client, not just your client, but also you as well for filing this incorrect claim. So you have to be very careful when you are submitting these claims to make sure you have all the correct supporting documents and you've tried your hardest to make sure this is very accurate, because generally as tax professionals, we don't always have we don't always have any professional liability on these type of things, but CRA, due to the generosity of this claim, they've really decided to come down on people who have not been doing this correctly. So before I get into the voluntary disclosure program, I just want to know if there was any questions about any of the incentives that I discussed, or comments that you guys would want to share with the rest of the people here listening to this presentation. Okay, sir.
Thank you. Thank you, Karen. Ladies and gentlemen, anybody has any question, you can just type your question into the Q&A area, and Karen is here. She's ready to answer your question. And before we jump into the new topic, we're just going to take a picture. So may I request everybody, if you can please turn on your cam. Just for a moment, we will stop sharing our screen and we'll just take a picture of everybody into the presentation here. Okay, before this, we take a picture. There's a question from Peter Sharma, probably. It says, wages subsidy for period 1 to 4 can still be applied or it's too late?
Yeah, you can still apply for the wage subsidy for all of those periods. There's no hard deadline that CRA has kind of given on that.
Mr. Peter Sharma, you have any subsidy question? Please, you can write your question there. All right, okay. So thank you very much, everybody, for being with us now. We will jump into now the topic number 2, if our presenter is okay with that.
Yeah.
Okay, so we'll just go ahead and share our screen now.
I believe someone's mic is not muted.
Okay.
You can mute it. Okay. Okay. So I'm going to talk about the voluntary disclosure program. I don't know if any of you are familiar or have any stories of your clients or anybody you know using this program. Actually, this program was has changed significantly as of 2018. You know, the government had noticed that a lot of people were actually abusing the voluntary disclosure program by, you know, not filing on time and using this voluntary disclosure to relieve themselves from significant amount of penalties. And so the CRA found that a lot of people were abusing this, or they were taking advantage of it using offshore accounts and then, you know, not and taking advantage of that deferral and for several years, and then maybe 10 years later, they for some reason want to disclose, and they would. So CRA saw that there was a lot of abuse being by taxpayers on this. Oh, that. Sorry, guys. I can see that. I can't see this. Yeah.
You want to?
I want to present that one, but I want to find the presentation on that. Is it you? Was that what didn't show?
Yeah.
My notes?
Yes.
Oh, I see.
You cannot see the notes.
Oh, okay.
So
Can you make the screen like that? The main screen?
yeah.
Sorry, we're having a technical difficulty. So I guess because this is the main screen, that's all.
So you want to share this presentation, right?
Yeah, I want to share the presentation, but I want my notes to be able to, like, the notes are too small on that screen.
Or you cannot.
Oh, I can't.
No. You just
Okay, sorry about that. About the voluntary disclosure program. So essentially what it is, it gives taxpayers the opportunity to correct inaccurate or incomplete or disclose information that has not previously been reported. So a lot of times, people will not file certain forms, but they had no idea they had to file a form. And like a common one that I've seen for a lot of my clients is the T1135 form, which is the foreign income verification form. So that is like for any taxpayers who have income, foreign income or foreign assets of over $100,000 are required to file this form. Now, a lot of times we don't go into the shareholding detail of every single one of our clients. We don't know all of their investments that they hold in unregistered accounts. So, we don't usually ask the client about that. And a lot of times they don't tell us because they don't know this is something that they need to disclose. And this form gets unfiled, and the penalty for that is a maximum of $2,500, which is significant for a lot of people, and especially if they haven't filed it and they've owned those assets for several years. You're looking at 2,500 times the number of years that they held those assets, and that can really add up. And so the CRA, they don't want to penalize people and prevent people from disclosing things or reporting income that they should have reported that they either didn't know that they had to report, or for whatever reason they didn't report it, even if there was an intentional situation. Sorry, give me 1 second. KSER just needs to come on.
I guess to our audience, probably they're not getting proper display of the screen, so just going to stop the sharing.
Okay. Okay.
Please.
Okay. Okay, sorry about that, guys, again. Okay, so for the voluntary disclosure program, essentially, if you have a client or somebody who has failed to report certain income or didn't report, file a certain form that they were required to file.
I'm sorry to disturb once again. It's looked like still it's not working. So just a moment, please.
So
Okay,
it's
sorry
working
for that.
there.
Yeah.
Okay, so this is.
Yeah, you can continue.
So if I go. Okay, so it's good? Okay. So, okay, so now, for this voluntary disclosure program, previously you were able to apply to CRA on a no-name basis. So you could essentially give CRA, send them a letter and let them know on a no-name basis with all the facts, the scenario, the amount of tax that's due, and the penalties that would have been incurred, and you could ask CRA to confirm if under those facts and case and scenario, if they would accept this BDP application. Because a lot of time, because the taxpayers are kind of, there's risk here, because if the CRA decides that, no, this was intentional, you purposely should have known, you're a repeat offender, or for for whatever reason, the minister decides that you don't actually qualify to get this taxpayer relief of penalties and interest, and your claim is denied, now you've kind of exposed yourself, and you have no option but to now pay all the penalties and interest. Whereas if you didn't report it, you could kind of slide it under the rug and you would be getting away with it for as long as you could, until maybe CRA 1 comes at you at one point. I mean, if you're an individual, they can only come to you for a maximum of 10 years under this program. But now CRA, due to like people abusing the whole system, as I explained, the CRA does not allow for you to submit a request under a no name basis. You have to submit the full application, and you kind of put yourself at risk because the minister is going to decide if you fall under what sort of program you fall under. So there's now 2 tracks to the voluntary disclosure program. There's called the general program. So the general program, if you qualify under this program, you are eligible for penalty relief, full penalty relief, and partial interest relief. If you do not fall under the general program, you would fall under the limited program. And the limited program is generally for people who this minister believes was disclosing this non-compliance because there was an element of intentional conduct. So the taxpayer knew that they had to file this, but they intentionally didn't. And now, because the penalties and the interest accruing on the reporting of this are so high, they are disclosing it under the VDP program because they do meet the 5 criteria that I'll explain later, and they are eligible. But because there was intentional conduct, they would not be eligible to get under the general program. They would fall under the limited program, and the limited program does not provide any interest relief. They do provide some penalty relief. The other thing that allows the voluntary disclosure program, if you apply under this to report your income, is you're protected from criminal prosecution. Tax evasion is a criminal offense. So now disclosing it under this program, you will be safe from any sort of criminal prosecution for, or gross negligence penalties, which are very significant penalties as well. You would be protected from those scenarios. And okay, so additionally, there's 2 guides that the CRA has when you're doing a voluntary disclosure program. When you're applying for that, there's the ICOO 1R6. That is the full detail guide for the voluntary disclosure program. It gives you the full details of what forms you need to file, what's going on, like what makes you eligible for this program. And then there's another guide that generally when you file under the voluntary disclosure program, you also want to typically file for taxpayer relief provisions if your client does qualify for the taxpayer relief provisions, which I'll explain what the taxpayer relief provisions are. And sometimes clients can qualify under both programs, and then therefore they would get full interest and full penalty relief under the taxpayer relief program, where the voluntary disclosure program, yes, it gives you relief from penalties, but it only gives you interest relief of 50% for the 3 most preceding tax years. So, I'm going to explain to you a situation I had with my client. It was a very unfortunate situation. Actually, she was married for several years. She was recently widowed, and her husband was, the breadwinner of the family. And he was responsible for filing all of the taxes, tax returns, and, the financial aspects of the home. There are, in their late 60s. So he was kind of semi-retired at that point, right before he died, and she was also she's never worked since she basically got married. So for 40 years, she hasn't had a job, and he died suddenly. And so when she went to go file her tax return for 2019, she went to her local tax office, and she went to file his terminal return. And it was discovered there that her husband had not filed his taxes for the past 10 years. And so one of the and he earned significant amount of income, and he was self-employed as well. He was a self-employed salesperson, so he earned mostly commission income and bonuses on sales that he was doing in the chemical industry. That was what his background was. So of course, none of his income that he earned was subject to withholding taxes. And so a lot of and on top of that, he was commonly reimbursed for his expenses as well. So he had several expenses that he incurred that were reimbursed, but based on all of when the taxpayer had to go back and try to figure out, what was the income that he earned in that 10-year period, he had several deposits of and trying to figure out what was sales and trying to figure out what was actually expense reimbursements, and then trying to find the expense details of those expenses. It was really difficult for her to get that information. Of course, for 10 years from today, she didn't have all the information. But as part of her role as a spouse, that she would get the estate, and she was personally liable for this tax that she had to pay in order to accept the rest of the estate, as she was his spouse. So that's the scenario, and then I will bring that scenario up. I don't think this slide is changing. Okay, well, hopefully you can see the next slide. I'm not sure if you can, but the next slide is the details of conditions of a valid VDP application. So now that the CRA doesn't allow you to submit an application on a no-name basis, it's really important that you ensure that your client is meeting these 5 conditions that are required to be met in order for your client to be eligible for this, because you don't want to subject them to these penalties and interest that they might not have had to pay had they never disclosed. So the 5 necessary conditions in order to apply are, the first condition is that it has to be voluntary. So what that means is that if CRA basically cannot know that this is something that you have to report or file. So as soon as CRA contacts you, let's say you didn't file your tax return for 10 years. So let me, going back to the example of my client, her husband didn't file his tax return for 10 years. And if CRA, so now she filed his 2019 terminal tax return, but she hadn't filed the previous 10 years of returns. Now, since she's filed the 2019 return, CRA kind of gets flagged that, okay, this person has to be filing a return. He filed a return, he had income. Where are his other 10 years of tax returns? And a lot of times that's a trigger for CRA to right away send you a demand to file letter. And as soon as CRA sends you a demand to file letter, this whole VDP program, you cannot apply. It's tainted, because now the CRA is aware that you need to be filing something. So as long as you voluntarily are coming out to disclose this information, and it's not something that CRA has demanded that you file, or or something under audit that CRA discovered that you had to file or that you had to report, as long as CRA doesn't know about it, the condition 1 of it being voluntary would be met. So in the case of my client, as soon as she filed the 2019 tax return, we were rushing. We had a 1 month period that we gave ourselves, and we were rushing to make sure that we submitted this application before CRA had the chance to send the client a letter to file these tax returns. So the second condition, hey, sorry, Kaser, were you able to see this slide? Okay. No sound. Okay. So now. Okay. Okay, hopefully you guys can hear me now, and hopefully you guys can now see the slide that I was talking about was the conditions of the valid application. So I talked about the voluntary component. So the second component is that it has to be complete. So now once you've submitted this, submitted something and disclosed something, you have to make sure to the best of your ability, to the best of your knowledge, the best of the information available to you, that you have included everything, disclosed everything. Because once there is something that if CRA finds that there's something else that you didn't include, that you should have included, that's going to taint this whole application, and you're not going to be able to, your application will be denied. Okay. So now, so that's complete. So now let me going back to the scenario for my client. She obviously had no access to her husband's income records or his expense reimbursement records. And she also didn't have any information on any other slips or anything else that he should have reported and may not have reported. So, sorry. We're still having these technical difficulties. I really apologize for this. Yeah, that's the presentation. Okay, so yeah, so going back to her scenario, she obviously couldn't figure it out, and of course it would be if she reported every single deposit that her husband received in the bank account, she would be really overstating his income, because a lot of times he got reimbursed for expenses, and her husband would travel all over Canada, all over the US. There would be expensive flights, there was hotel accommodations, there was meals, there was entertainment, there was telephone bills, there was, a lot of expenses that he incurred to, make those sales that either were reimbursed by his client that he was making the sale on behalf for, or they were just expenses he paid out of his own pocket that he, as a salesperson, would be eligible to claim against his income. So we don't want her to overpay her taxes by including every single deposit. So, what we did is we suggested to her was to go back and go to all of his credit card statements and start going through and figuring out where, the flights. And she was a very organized woman. Unfortunately, her husband was not, but she was very organized and herself, and she knew all of his trips. She had a calendar. She would save all of the trips that he made, where he would go, and the dates that he was gone for. So she kind of matched that up with the credit card statements and was able to figure out, okay, there was a flight to WestJet this time period. Yes, he was gone on a trip this time period, because they didn't travel a lot themselves, because he was always traveling. So most of those flights, any accommodations mostly, would be very obviously for business purposes and not something personal, because they didn't travel as a couple too much throughout the year. So she was very easily able to identify these expenses. So that was something that she had to do for, as many years as she could, and months that she could find these credit card statements. And that really helped her reduce the tax liability. And it was, done in good faith, because obviously, due to the nature of his business, it was very clear that those were business related expenses. So that was something that we included as part of our submission to make sure it was a complete submission. The third condition is that there has to be a penalty involved. So if there's no penalty involved in, let's say you're actually do a refund or whatever form or late taxes doesn't involve any sort of penalty, you cannot file under a VDP, because VDP is specifically relief from penalties. So there has to be a penalty involved. So if any of the years that there's a refund involved, you're not going to file that for under the VDP. You're going to file that separately, but not under the VDP application. So yeah, in the event that a penalty does not apply, the taxpayer, cannot seek relief through the VDP, and they would just submit their information as they regularly would, even if it's late. The other condition is that it has to be 1 year past due. So it must include information that relates to a taxation year that is at least 1 year past the due date of filing. This program is not meant to be used as a de facto filing extension. So it has to be fully 1 year due. And as people were previously doing, they would wait 1 year they would file it late, they wouldn't have their information together on time, and then they would wait for a year to pass, and then they would file under their VDP, and they would continually file under the VDP every single year for the same mistake, for the same form or the same tax return. And that was something that was CRA was allowing, but now CRA is really looking into each taxpayer on an individual level and seeing how many times did they submit this type of information for under the VDP. So if you file your T1 late every year and there's a penalty on it, you cannot file under the VDP application more than once for the same return or for the same type of disclosure. So the other thing, though, however, is that if the application includes information that relates to a taxation year that is more than 1 year due, and it also includes an application for the most recent year that is for the most recent year, so the 1 year period hasn't really passed, then the most recent year will also be considered under the VDP. So for my example, my client, her husband, when she filed his 2019 return, there was also information that she was supposed to report in the 2019 return that she didn't know she was supposed to report, mostly pertaining to his investments, because she didn't have the information at the time. Since we were applying under the VDP for the past 9 years, we were able to also include the 2019 tax year, even though it wasn't over 1 year past due. We were able to include it in our VDP application and have it considered as to not have the penalties and the interest applied on it. The fifth condition is that is a payment condition. So the taxpayer must include a payment of the estimated tax owing on their VDP application. So even though you don't know if your application is going to be accepted or not, but the payment of the tax has to be paid. It's a requirement. So but however, if a taxpayer doesn't have the ability to make the estimated tax owing, they are allowed to request to be considered for a payment arrangement, which would be subject to approval by the CRA collection officials. And in order to have that payment, in order to apply for the payment arrangement and be considered, you have to submit a lot of information to the CRA that to provide information on why that proves your inability to pay the tax liability at that date. And you have to provide disclosures of all your income, all your expenses, your assets, and your liabilities to support your case. And that's something that will be reviewed by the collections official in part of their determination if they accept that you qualify for a payment arrangement. And the payment arrangement will need to, and sometimes the payment arrangement will need to be supported by security. So for example, my client, when everything was said and done and we prepared her husband's 10 years of tax returns and included as many deductions as we could, his income for those 10 years was $1.25 million. So the taxes on that were, the taxes, including the penalties, the estimated penalties, including the estimated interest, and then you also have interest on the penalty. That whole calculation ended up being almost $650,000. That added up. So she doesn't have $650,000 just to pay to the CRA in one day. So of course she requested to have this payment arrangement, and we had to submit a lot of details about what her monthly income was, what her monthly expenses were, all details of all of her assets. And, the only asset that she really had was the home that her and her husband lived in. That was worth about $1 million. So at this point, like, we just recently submitted this, so we don't know the outcome of like what CRA is going to do and how they're going to deal with this situation. But I mean, it's very clear in this case that she would not be able, the quality of her life would have been severely impacted if she had to sell her family home in order to pay this tax that she was not even responsible for to begin with, and didn't even know was something that had to be done. It was completely out of her control. And the CRA is really, they look at that and they consider those things when they're making this assessment of if you qualify for this payment arrangement. It is in not the CRA's interest at all to put any Canadians, any taxpayer in a negative life situation, and to reduce the quality of their life. That is not something the CRA would want to do. And so if they see that like this is obviously something that cannot be paid in full today or tomorrow, they are ready and willing to figure out an arrangement that would work for the taxpayer. In this case, what we suggested the CRA might do is just put the house up as a security. So since she's about 65, she still has, we don't know how long she has, but like she might live until 80 or 90 and so she has a lot of years to still, enjoy her life. And if she had to sell her home, she would not be able to buy another home and maintain her quality of life. And so that's so CRA would probably in this case might put a security on her home, and once she sells that home sometime in the future, that tax would be probably paid at that point. So the other issues with the VDP application is that if a submission is denied, there is no right of objection under the Income Tax Act for the taxpayer to dispute the denied or partial relief. So the minister is able to decide if you get full or partial, and partial relief would be under the limited and full would be under the general, and it's all up to their discretion if they want to accept it or not. And you can object this decision. But if you do feel that the minister has not been exercising discretion in a fair or reasonable manner, then you basically have to go to court. And you can make an application to the federal court, and you'd have to do that within 30 days from the date that you receive the notification from the CRA on the decision of this application. So the taxpayer relief provisions, this is a completely separate program. So taxpayer relief provisions allows the CRA to provide taxpayers relief from interest and penalties due to issues that come up through no fault of their own or caused by some sort of personal misfortune or circumstances that were beyond their control. So this has nothing to do with you voluntarily disclosing information that you hadn't disclosed previously. The taxpayer relief provisions are really to help people who, for some reason, weren't able to, let's say, file their tax on time. Let's say maybe their house burned down and all of their tax information got erased, and they don't know, and now they're suffering from the loss of their home, and they've missed the tax deadline, and they were only able to file their tax return maybe 1 year or 2 years due to the trauma and the stress and everything the hardship that they're facing. So in this scenario, you would want to file a taxpayer under the taxpayer relief provision and in this case, this would provide relief of those penalties and interest. The CRA, to note, will only grant relief requested within a 10-year limit. So let's say in this example, a taxpayer has debt for the 2004 tax year and makes a request for interest relief in 2017. The CRA can only grant relief from the interest that is accrued during the 10-year period, which would be from January 1st, 2007 to December 31st, 2016. So any interest that has accrued after December 31st, 2016 to the date that the request was made in 2017 would not be protected. Any interest from prior to 2007 would not be protected. I flipped that around. So the 2004, 5, and 6 interest that was accruing, that will not be granted any sort of relief. And there's certain circumstances that taxpayer relief provisions can be applicable. One would be extraordinary circumstances, such as my example, your house burning down, natural disasters, serious illness or accident, or some sort of emotional distress, such as a death in immediate family, that would qualify under extraordinary circumstances as well. The second circumstance would be actions of the CRA. So like processing delays that resulted in the taxpayer not being informed within a reasonable time that an amount was owing. Or errors in material available to the public, which led taxpayers to file returns or make payments based on incorrect information. So anything that was really the fault of CRA, if it was the CRA's wrongdoing, and that's why this penalty and interest was incurred on for the taxpayer, then this would be acceptable under the taxpayer relief provision. The third would be inability to pay or financial hardship. So when a taxpayer demonstrated ability to pay requires an extended payment arrangement, consideration may be given to canceling all or part of the interest for the period from when the payments start to the amounts until the amount owing are paid. So essentially, when payments of accumulated interest would cause prolonged inability to provide basic necessities or cause severe financial hardship, or inability to buy food or medical care or transportation or accommodation, and when a taxpayer cannot make a reasonable payment arrangement because interest charges would be so significant, the CRA would consider canceling those interest and penalties. So and the CRA will review in detail the taxpayer's financial situation to determine their inability to pay any amounts owing, and the interest charges that would continue to accrue. And a financial review would be done. So the income and expenses, the assets, liabilities, the taxpayer's ability to borrow funds and their ability to sell certain assets, and actions and efforts to pay the amounts owing would all be considered by the CRA. So going back to the example of my client, of course, because the BDP only gave interest relief, it gave full penalty relief, but it only gives interest relief for of 50% for the 3 years, and we were filing for 10 years, and 50%, and the accrued interest was so significant because his income per year for those 10 years was so significant that the penalties and the interest on the penalties and the interest on the tax payable was so significant that she was unable to pay. So she qualified under C. She also qualified under the extraordinary circumstances because it was her husband died. But more so, we're filing the taxpayer relief provision under her inability to pay.
Sorry.
Oh.
You were here, right?
Yeah. Okay. We were filing under her inability to pay and financial hardship. So, with that, under this application, we had to also submit a lot of other information to try to prove this this inability. And so we'll see what the CRA does. So part of when you're doing the VDP, there's the relevant forms required. In my opinion, my suggestion of what forms you should be filing if you are planning to make a VDP application for any one of your clients or for yourself would be to submit a letter to CRA, a cover letter that explains the facts of the situation, and a short explanation on how the taxpayer has demonstrated that they meet all the conditions of a valid submission. So it was those 5 criteria, list out those 5 criteria and write a little explanation of how the taxpayer has demonstrated that they meet that condition. So for CRA, the more information you give there, the more you try to explain to them, the more favorable outcome you'll have, because there's less assumptions that they have to make on behalf of what's going on. So the other thing that you have to include if under the VDP submission is a form RC 199. That is a required form that you need to include. And then also when you're filing that form, you also, let's say you are preparing this form for your client, you have to report that your client received assistance from an advisor in respect of the subject matter of the VDP application. And the advisor name would have to be generally included in the application as well. The other form that is relevant, that may be relevant if you meet the criteria of the taxpayer relief conditions, would be the RC 4288. That form just details how you qualify for the taxpayer relief, what is the amount of interest that you're requesting relief for. And then with the RC 4288, let's say you're not even filing a VDP, you're really just filing a request for taxpayer relief, and you're requesting it under the financial hardship criteria. You should also submit the RC 376. This form is essentially just a statement of income, expense, asset, and liabilities for individuals. And it's a very thorough form. And so it will help guide you in what things you need to consider as part of determining someone's financial situation, and communicating that as well to the CRA so that they can be convinced that your client does qualify under the taxpayer relief. And then same thing, you would also want to file the same form if, let's say, your client is not able to make the payment. So remember, the 5th condition was payment. You have to make the payment of tax, but you can request a payment arrangement. And so that's when you would want to include in your submission the RC 376 so that you can also support why your client is not able to make the payment under the VDP right away, and support the request for the payment arrangement. And lastly, the other information you want to include would be a copy of the forms, of course, that you're filing under the VDP. You cannot e-file this stuff. You have to print it and submit it in paper form to the CRA, or you might even be able to upload it onto your My Business account or My Represent a Client account. It might be an option there. I haven't personally done it that way. I've mailed this information, but you also want to include the returns and the slips that are being disclosed. And another thing that is part of the asset and liabilities is you want to try to get as much third-party information to support that your asset and liability and your income and expense. As much third-party information you can get, that would help support that. So statements from your bank that details all your assets and their fair market value and their cost basis, or details of like your mortgage statement, details of your bank statements, details of like utility bills or something like that. That'll help support what numbers and information you're including on that form when you're requesting for taxpayer relief under the financial hardship, or you're requesting for a payment arrangement under the voluntary disclosure program. So that pretty much sums up, the voluntary disclosure, and it also sums up my presentation. So hopefully you all, learned a lot and bore you to death with tax. I know it can be a very heavy technical topic, but hopefully you can apply some of this information for your clients. And thank you very much for listening and attending. If you have any questions or comments, I would love to hear them and answer that for you. I think our team here is trying to figure those out. Whoa.
Hello.
Okay, there's quite a bit of questions. I think someone's mic. Hi.
Hi, my name is Joseph Montes. I would like to ask you about this non-resident tax withholding one. There was a charge come up to one of my client because he didn't file it on time. He thought that the CRA has given time for GST till June 30th, corporation tax till September 30th, like that. He expects that non-resident tax also given time, but unfortunately they haven't given time for that one.
Yeah.
The result, he paid after 2 months in full, but they send an heavy interest charge, and I filed a tax relief form to give her, the reason is the extraordinary situation, not on the financial reason, but under the category of extraordinary circumstances like COVID business lockdown. And given all the explanation that we are not in the intention of, disavowing the tax status, statutes, or some error occurred, in the emotional state, something like that. So given an explanation. So based on that, will they be able to communicate with us and then do something, or they keep on sending us interest charges? And how long will it take to process this application from the CRA side?
Yeah, so I mean, the CRA right now is like so backlogged, and it's really difficult to try to get any information really in a timely manner from them. But I mean, in terms of the accruing interest, once you submitted that, you would qualify under the CR, like for that accrued additional interest that they keep adding onto that. CRA would waive that under the CRA, the second bullet point that I had there, where it was like CRA's kind of fault that they have been continually accruing this. But like, I mean, to be safe, I mean, I'm not sure if CRA would in that circumstance accept the extraordinary circumstance, but I feel like they would, because I think they're giving a lot of leeway for people who are facing a lot of hardships because of COVID. So I'm not CRA, so I don't know if they would accept it or not, but it's really up to the discretion of the minister at that point. But if your letter was very detailed and explaining, why this error happened on part of the taxpayer, and what the really explaining what that extraordinary circumstance was, and if it was very convincing, the minister might accept it, and they would stop the interest charges and they would probably, if they accept it, they'll waive everything, so there's no issue of like the additional interest or anything. If they don't accept it though, then you might want to file another taxpayer relief under the second provision, being just saying, you took too long to get me the information of this when I requested the relief. So then therefore requesting the relief of having that additional interest. But you do risk that they might not accept that either. So the best thing would be for your client to like pay that interest and then request a refund if he does qualify for the taxpayer relief.
Okay. And how long they normally will take to process the application? How long they normally take?
I I feel like CRA generally, I think required, they have to do it within 30 days. But I think that's their client, their service mandate is within 30 days to at least get something processed. I know right now, like everyone's working from home and all of the CRA whole administration is really kind of in shambles because of COVID. So the processing times are way, way longer now. So I don't know what their timeline would be. The best thing would be to like call CRA and ask them if they've received this application and get the status update from them. And as long as you are, doing everything and being diligent and on top of it, then it'll show a track record that, it's not your fault that all of this additional interest and all of this is accruing. You filed under this relief provision for these these circumstances, extraordinary circumstances, and they're the ones who are delaying the response. And that's really the only way you can try to get them to pay attention to the file. Like, it's really like the timeline is really difficult to figure out right now. But you can file a service complaint. If let's say, they contact you and they say something like ridiculous, like 6 months, or they say, I believe CRA is required to service within 30 days. So you can submit a complaint through the CRA for a service complaint, and that generally speeds things up, from my experience at least.
Right. And also the interest charges are coming in the first place. It's a computer generated one, not the human, right? From the beginning of the state.
Sorry, what did you say?
No, the interest charges, when they send it to you, it comes, the system automatically charge and send it to you. Well,
Yes.
once you file only, they will go into look into it.
Yeah. Once if they accept your application, they'll reverse all of it.
Okay.
Yeah.
Okay, thank you so much for help. Thank you.
Yeah, no problem. Okay, so somebody asked if you're going to get a copy of the slides. Yes, you will get the copy of the slides and along with my notes. So you can use that for your reference. I have another question here from Joseph. How long, okay, I answered this one already.
Thank you so much.
Yeah, I answered this one already. Okay, I have a question from Sohaib. Thank you for all the detailed information. I would like to mention that there are a lot of legalities and exposure with VDPs, being that tax and I think you mean evasion is a criminal offense. Accountants should understand that a tax lawyer should handle VDPs in many cases, at least initially. For sure, a lawyer should be consulted by the client. Furthermore, an accountant may not want to know or get involved in the undisclosed matters of the client. Accountants must remember that they can be compelled and do not have client privilege. Accountants can potentially expose their client in the process. Their client may not be protected should their accountant be compelled. It can be expensive for the accountant dealing with it and not getting paid should it become a legal matter. It depends on the magnitude of what needs to be disclosed, obviously, but it is hard to draw lines where you are in the process of uncovering undisclosed tax matters and you may not end up knowing too much. Oh yes, this is continuing. Okay, many accountants handle VDPs. It's highly recommended to refer to a tax lawyer for VDP, especially for anything such as possible tax evasion or a new client. I totally agree. Like if there is some sort of like fraud or possible tax evasion, and it's this becomes a very high risk situation in terms of the VDP, because obviously like not everything's being disclosed, but yeah, like I appreciate this recommendation. Tax lawyers generally do handle like very high risk disclosures, but I mean, as long as your client is disclosing everything, I mean, I think the onus would still be on the client and not the person filing it. As long as you have like all the proper engagement letters in place with respect to the disclosures, I think that will really protect accountants, like their engagement letters. I think that's all the questions. I don't know if anyone else has any other questions.
I have just a comment, Karen. Thank
Yeah.
you for the time today. I'm Annie Paul Brosnan's partner. Based on experiences with our firm, CRA has noted to us on many accounts for receipt of documents, or whether it be fax being mailed, or now saying that it takes up to 6 weeks to receive in their system right now due to COVID backlog. And some BDPs are taking up to a year. So we've got a few BDPs in process right now as well. They're taking up to a year, if not more, depending on the circumstance and situation. So it can get quite lengthy depending on the circumstance.
Yeah, CRA is just like this COVID thing. They're already really slow before COVID, and now it's like COVID, and it's even like 10 times slower. So yeah, it's really difficult for clients. I mean, my client who's just doing this BDP, she is super anxious. I mean, having a $650,000 tax liability is like super stressful for her. So, I mean, all we can really do is wait and like follow up and try to get them to get on it. It's like just a waiting game now.
It is, unfortunately.
Yeah.
Thank you for your time today.
Thank you. Okay, if nobody has any more comments or questions, I'll let
anybody
Taser.
have any other question? You can please unmute yourself and you can ask question directly to our presenter.
Okay.
I'm looking forward to the presentation details. So this is great information.
Okay, awesome. I'm glad you enjoyed it. Okay.
Right. Thank you very much, ladies and gentlemen, for joining us. All those who have already paid for this event, they will get a presentation copy as well as the certificate of CPD over the next couple of days. Once again, thank you so much. And now may I call upon to our treasurer, Mr. Naseem Kader, to present the card of thanks to Ms. Kiran.
Oh, thank you so much.
Thank you very much for
Thank
coming
you.
and spare some time for our members, and we had a good discussion.
Thank you.
So, God bless you.
Thank you. Thank you so much. Thank you everyone for attending, and hopefully this was very helpful and useful for you.
Thank you, ladies and gentlemen. I would take this opportunity to call upon our president just to say a few words about today's presentation. So in any moment, our president will be here. Just stay with me for a moment, please.
Thank you very much. I really appreciate everybody's participation, that who have taken their time on this unprecedented time to come and learn. I think Society of Professional Accountants of Canada strongly believe on continued learning process, the CPD that we already enforce on our members. And I think learning is very important. And I know we're going through this unprecedented time, and we are also getting into the lockdown starting this Monday. So I wish everybody, to stay safe, stay home, keep the distance. At the same time, I would like to thank the presenter. She did an excellent presentation. I wish that this presentation should have been maybe a couple of months earlier. So all these our member accountants could have made some more money by helping their clients to apply for these benefits effectively and quickly, so they can also earn some money, extra money. And I think you can still apply. There's a no, if some of your clients who have not applied any of this pandemic subsidies or benefits, they can still go and apply. And if you need any help, always consult to your peer and ask questions. And I just wish everybody a very healthy, safe weekend. Thank you very much.
Right. Thank you, ladies and gentlemen. We will send you a survey shortly. Kindly just keep checking your email, and your response and your comments. It will highly be appreciated. Will be great support for us to improve our presentation in the upcoming months. For the next 3 months, we are going to send you the schedule of our upcoming 3 webinars. So those who would like to enjoy, learn something more, please just register. And thank you very much once again. And thank you to Ms. Karan for sharing such a nice presentation. Thank you very much and have a good day.
Bye.
Thank you.
Thank you.
Bye.